Markets never move in a straight line. Booms and busts, optimism and fear, expansion and contraction, these patterns repeat across decades, shaping wealth and opportunity. Understanding economic cycles is the key to navigating uncertainty and building lasting success. In this video, you will learn why markets move in phases, what drives these cycles, and how investors can position themselves to thrive through every turn. Like and subscribe to gain insights that turn market patterns into strategic advantage. 1. Understanding economic cycles. Economic cycles are recurring patterns of expansion and contraction in the economy. They are not random events or mere speculation. Growth leads to increased production, employment, and spending, creating an upswing. Eventually, overextension, inflation, or external shocks slow growth, triggering contraction. Markets reflect these cycles as stock prices, real estate values, and investment returns fluctuate. While investors often focus on daily market noise, cycles provide the deeper context that determines long-term outcomes. 2. Expansion, the phase of optimism. Expansion is the phase when economies grow, companies hire, and consumers spend freely. Stock prices rise, employment increases, and confidence is high. This phase is driven by investment, technological progress, and innovation, which create tangible growth opportunities. However, optimism can become excessive, leading to speculation, inflated valuations, and risk-taking beyond sustainable levels. Investors who understand expansion do not simply ride the wave blindly. 3. Peak, the tipping point. Every expansion reaches a peak, a point where growth slows and risk rises. Indicators such as inflation, high interest rates, or stretched valuations often signal the approaching peak. During this phase, markets can appear volatile, with sentiment swinging rapidly between confidence and doubt. Investors who fail to notice this shift may become overexposed and vulnerable to losses. Peaks are subtle and rarely announced. They require observation of economic data, market psychology, and systemic trends. 4. Contraction, the phase of caution. Contraction occurs when growth slows, spending declines, and market activity diminishes. Companies may reduce hiring, production falls, and investor confidence wanes. This phase often triggers fear, selling pressure, and short-term losses. However, contraction also creates opportunities. Weakness in markets exposes undervalued assets, allowing prepared investors to acquire high-quality investments at reduced prices. Contraction tests: discipline, patience, and strategy. 5. Trough, the bottom of the cycle. The trough marks the lowest point of the cycle, where fear is at its peak and opportunities are often ignored. Economic indicators begin stabilizing, markets find support, and pessimism is widespread. For many, this phase feels discouraging. However, historically, troughs offer the most significant opportunities for wealth creation. Smart investors recognize value, assess fundamentals, and prepare to increase exposure before others return. 6. Recovery, the beginning of a new cycle. Recovery signals the start of a new expansion phase. Economies regain momentum, corporate profits improve, and confidence slowly returns. Early investors benefit disproportionately by entering before widespread optimism drives valuations higher. The recovery phase rewards those who prepared during contraction and maintained discipline. Recognizing early signs, such as improving employment, increasing production, or stabilizing interest rates, allows investors to act before the majority notices. 7. Market psychology, drives cycles. Human behavior magnifies economic cycles. Optimism during expansions fuels speculation, while fear during contractions drives selling. Psychology amplifies natural economic rhythms, creating volatility and opportunity. Herd behavior, overconfidence, and risk aversion all contribute to the extremes of cycles. Investors who understand this dynamic focus on fundamentals rather than emotion. By separating perception from reality, they can navigate swings with clarity. 8. Economic indicators as guides. Indicators such as interest rates, inflation, unemployment, corporate earnings, and GDP growth provide signals about the phase of the cycle. Tracking these metrics helps anticipate turning points before markets react fully. For example, rising interest rates may indicate a late-stage expansion, while declining unemployment could signal recovery momentum. Indicators are not perfect predictors, but they offer context that allows investors to align portfolios with underlying economic conditions. 9. Portfolio positioning across cycles. Investors can align allocations with cycle phases to optimize outcomes. Defensive positions such as bonds, cash, and stable dividend stocks protect capital during contraction and peaks. Growth-oriented allocations thrive during expansion and recovery. Hedging and diversification reduce risk without eliminating opportunity. Active monitoring of allocation ensures portfolios remain aligned with cycle phases. 10. Long-term perspective in cyclical markets. Economic cycles remind us that markets move in predictable phases over decades. Short-term volatility is inevitable, but wealth accumulates through disciplined, patient, and informed positioning. Understanding that expansion, peak, contraction, trough, and recovery repeat allows investors to anticipate trends, manage risk, and act strategically. Long-term perspective separates those who survive market swings from those who falter. Cycles are the underlying rhythm of markets, and aligning investment strategy with this rhythm transforms uncertainty into opportunity. Those who respect cycles achieve sustainable wealth through knowledge, discipline, and foresight. Markets move in phases, but success does not depend on guessing the next turn. Understanding economic cycles allows investors to protect capital, anticipate opportunities, and navigate volatility with confidence. By studying expansions, peaks, contractions, troughs, and recoveries, disciplined investors turn predictable patterns into lasting advantage. Like and subscribe to continue learning strategies that transform market uncertainty into long-term wealth and growth.